This is Amit Pabari, founder and managing director of CR Forex. In last week video, we discussed that we are expecting USD INR pair to consolidate between 79.20 on the lower side and 79.80 on the higher side. Broadly, the rupee traded in the same range. Now let us see where the pair is moving in the coming days. From last couple of months, we have been discussing there are a lot of factors which are affecting the dollar rupee pair on a negative side, like higher dollar index, higher trade deficit, higher FII outflows. But there is one more factor which has been added in last few days, which is problems in China. Now let us analyze what are the key problems in China. Because of zero COVID policy and stricter lockdown, their manufacturing data, production data and retail sales data were bad. And China is having a property kind of a bubble, because of which a lot of banks are in trouble. Apart from that, there is a China-Taiwan escalation going on. And middle of all of this problem, Chinese central bank went ahead and they have deducted the interest rate on their economy, which is against the normal trend where all the central bank are increasing the interest rate. They went and reduced the interest rate, because of which immediately their currency USD CNH in the offshore market went from 6.74 to 6.84 kind of a level. Now 6.84 is a major resistance for USD CNH. If that level is taken out, then the currency can move towards 7.21, which is the first target, and 7.5, which is the second target. The probability of getting 7.21 is close to 75%. If USD CNH or Chinese currency get weakened from here, then it will have a negative impact on all Asian currencies, and it will definitely add pressure on dollar rupee pair. So overall, because of rising dollar index and weakening Chinese currency, we expect that the appreciation in the pair is limited and the overall trend of the pair remains on the weaker side. So in coming days, we expect the pair to trade close to 79.30 to 79.50 on the lower side. And for the upside target, we have to see what is RBI doing. From last 1 month, RBI has been successful in intervening close to 79.80 to 80 kind of a level. If 80 kind of a level is broken and Chinese currency weaken at the same point of time, then there are higher probability that we are moving towards 80.5 to 81 kind of level in coming few trading session. Now let us discuss strategy for thin margin exporters like chemical exporter or an agri exporter. From last week, they are taking costing between 79.30 to 79.50 kind of a level. For them, we are suggesting that they should cover 75% of their exposure between 79.75 to 79.80 kind of a level. For remaining position, they can target 80.20 with a stop loss of 79.30 or costing whichever is higher. Now let us discuss strategy for thick margin exporters. Thick margin exporters like textile exporter or engineering exporters. Last week we have suggested them two things. First, maintain a hedge ratio between 45% to 50%. And if the hedge ratio has fallen, then in order to maintain the hedge ratio, they can participate between 79.40 to 79.70 kind of a level. For this week, we suggest the same thing. Keep a hedge ratio close to 45 to 50%, as the overall trend of the pair remains on the weaker side, and there are higher probability that we can get 80.50 to 81 kind of a level in coming days. If the hedge ratio has fallen down below 45%, in order to participate, they can participate between 79.70 to 79.90 kind of a level. Now let us discuss strategy for importers. As the overall trend and the biasness of the pair is on the weaker side, that is why from last couple of months we are suggesting importers that any dips has to be taken as an opportunity to buy dollars. If anyone has missed buying at lower level, then ideally they can buy for their imports of next 30 to 45 days between 79.30 to 79.45 kind of levels. Now let us discuss trading ideas for coming days. in my last 15 years of career, one thing I have learned is that if the economy is not doing well, the currency will not gonna do well. Yeah, it is simple economics. So the economy of Euro and UK is not doing well, because of which the currency is getting hammered. So we had given a trade call, sell Euro USD between 1.02 to 1.0250 kind of a level with a stop loss of 1.0350. It was not able to break 1.0350. Now it is trading close to 1.0030. On Monday morning, 75% of the position you can book profit close to 1.0050 kind of level. If you do that, you will make 89,000 kind of a rupees on 75,000 euro if you book 75%. Similarly, on pound also, book 75% of the position close to 1.1850. If you do that, you will make money of 1,31,000 rupees. But the overall trend of the pair, both the pair remains on the downside. With this, I will end my today's presentation.